Perfect. With that being said, welcome to the second episode at Sovereign Day, live here from Buenos Aires. I'm sitting here with Nick from Celestia. Happy to have you on, Nick.
Thanks for having me.
Pleasure is mine, and yeah, we discussed it in the episode briefing. We're nearing Celestia's 2 years anniversary. Celestia is like one of the big players in the data availability space for the last 2 years, have pioneered the field, one of the first ones to talk about sovereignty, modularity, and all of these things. So where are we now? Where's Celestia right now? Can you describe more or less the situation the ecosystem's in right now?
Sure. So we just passed the 2-year anniversary mark in November 1st, so a few weeks ago. And it's been a wild few years. In some ways, I am surprised to the upside of how successful Celestia has been. Around 5 years ago when I first read the white paper, and it was just an idea, I wouldn't have thought that we would be here where we are today. On the other hand, when we launched 2 years ago, I feel like the whole industry was a lot more optimistic on the growth of applications in crypto and just sort of the broad demand to use blockchains. And I think to some degree, we haven't actually been able to yet escape just the more speculative use cases of crypto. And that's kind of meant that from our perspective, the actual growth of users and transaction volume and all that has sort of undershot our expectations. But I am seeing a lot of positive signs that we are starting to enter across the chasm from this early adopter, more speculative type of market into the more mainstream market, right? And so today at Sovereign Day, one of the themes is institutional adoption. I think that's very bullish for crypto as a whole because we can sort of re-architect the back end of the financial system by working directly with banks and institutional players. That's cool. We're getting more clarity in regulation, meaning that even fintech companies or even startups can now start to build on blockchain rails without having to worry about going to jail, which is a big step forward. So I do think a lot of these shifts that are underway will just take a little bit of time, but those of us who are close to the action, I think, are starting to see the first green shoots of more real world use cases that I could actually see my mom or a normal person who's not just trying to gamble use. And I think that that's hopefully a path to sustainable growth for the industry. So what does that mean for Celestia? Celestia's whole architecture kind of is designed for the endgame of crypto, where there's a lot of users, there's a lot of companies and startups. So a lot of users means we need a lot of transaction volume. A lot of companies and startups building on chain means they're going to want to have the ability to kind of own and customize their own infrastructure. So we're very big on the application specific chain thesis. And so Celestia is kind of an L1 that is designed for those two core functions. And we're still focused on that, scaling the block size. We've scaled, I believe, 128x from when we launched. We have now, I think, 2.5 billion in total value secured on the network. We have had over 3 terabytes of data published. I think if you average that out into number of transactions, that averages out to a few hundred transactions per second on average across the entire ecosystem since we've started. So overall, the metrics are quite good. And now we just have to hope that more of these apps actually start to grow, because as an infrastructure provider, you can't really grow unless the apps that are your customers are growing, and that's currently, I think, one of the bottlenecks.
Can you elaborate once again? Like you mentioned in the beginning that your expectations were partially exceeded.
Yeah.
So are these like the numbers that you're talking about, like the amount of data that you have been published and the number of value that has been secured, or like where are you seeing like, hey, wow, I didn't see that coming?
Yeah. So I think we've had over 40 different chains launch on Celestia, which is a pretty good outcome considering that it is still pretty difficult to launch your own chain, even though Celestia's made it easier by taking care of providing you with block space without having to have your own validator set. It's still expensive and a much more of an engineering lift to build a chain-based application. Yes, the total value secure, the total data published, all those things have gone relatively well. And I think that and again, that's with the context of 5 years ago, when this was just a white paper. I would say that something we've noticed is that a lot of the chains that have launched just haven't reached product market fit. So we're seeing this kind of culling and consolidation, I would say, across the application ecosystem, application layer of crypto in general. And that's definitely affecting the Celestia ecosystem as well. And so I think it's more about now focusing on, okay, what are some of the use cases that really have product market fit and are also a very good fit for Celestia's strengths. So one application vertical that we've been focusing on lately is central limit order book exchanges. So it used to be that you couldn't, if you wanted to have support an exchange on chain, it had to take certain shortcuts like automated market making, where it's a very simple system, but unfortunately the capital efficiency is low. The for users and even the execution of trades, there's a lot of slippage. The liquidity is not as good, and that's why a lot of the trading of crypto assets was actually done off-chain on centralized exchanges. Now we have, for the first time, a crop of applications that are building the same order book technology that's tried and true in TradFi, but building them on-chain so that we can have the same degree of liquidity, capital efficiency, price discovery on an on-chain venue. But the thing is, in order for that to work, they need really low latency and they need a high amount of transaction throughput, because the latency is important because markets move at the speed of light. You need to, you don't want your liquidity sitting there and getting stale when the actual price of the assets is updating elsewhere. So you want to be at the same, ideally the same latency as you would have at a centralized venue. And that's actually possible using rollups, because rollups allow you to have a single sequencer that is publishing data and consuming sort of block space on a decentralized layer one like Celestia in the back end. So you're going to get the best of both worlds. And then the throughput part is important because, exchanges, there are, thousands of orders per second, potentially per market. They're very, very active because you have high frequency trading happening, and that generates a tremendous amount of transaction throughput. And that's exactly kind of the world that Celestia is designed for, where we can support, as of today, around post this upcoming upgrade called Matcha, we can support roughly 50,000 transactions per second. And then within Matcha, via governance, we can upgrade to around 200,000 transactions per second, that's on the order of NASDAQ. NASDAQ, I think, maybe at peak times it exceeds 200,000 transactions per second or orders per second, but that's roughly the throughput of NASDAQ. So it's actually possible, I think it will become possible over the next few years to build a decentralized trading venue that has the scale of a venue like NASDAQ, and hopefully we scale much beyond that. I mean, the market, the TAM for an on-chain exchange is the entire world, right? There's not just one exchange in the US. but literally every exchange in the world could potentially be on chain.
I mean, that's super cool, and I mean, it sounds like that from a technical perspective, the ecosystem's on a very solid path. Let's really look also behind the network economics behind that, because if we zoom out, we need operators for that in the back that are basically securing this data and validate like the transactions. And the idea is that rollups pay for blob space with tier. So how do you see like the network economics behind all of that? Because this is like also your hope is that these rollups find product market fit, therefore more fee generations taking place, therefore more blob fees are getting paid in tier, which is then good for the operator set. So is this calculation playing out right now? Because I've heard also from a lot of operators like struggling, and speaking of the consolidation that you mentioned, the operator set is also consolidating because not enough fee generation is taking place. So how do you observe the economics behind that?
Yeah, great question. So there's actually, so we've been gradually reducing the inflation of Celestia. So we went from in year one, 8%, then down to 7%. With the recent upgrade, we went to 5%, and now with Mantra, we're going to go even lower to 2.5%. And then we are considering and working on a future upgrade called Proof of Governance, which actually gets rid of staking altogether. And then we have a baseline inflation rate of 0.25%. Now, the thing is, all of that money will go directly to the validators and operators to fund their setups and their operations. So the way that crypto networks typically work is that the inflation, I mean, Bitcoin started this way. The base fee goes to the miners. So like the protocol handles compensating operators for their work by directly minting tokens. Now, there's a balance and feedback loop of like how much money that is. Like in Bitcoin, it becomes unprofitable to mine. It becomes less profitable as the price decreases. And I think there's some mechanics similar in proof of stake networks. But the bigger question I think that you were getting at was like the revenue, right, and the fees. And I think that where we are today in the crypto ecosystem is you can no longer sort of just survive off of the hope for future fees necessarily, or without actually having some kind of plausible story to generate transaction fees at scale. And so that's always been sort of Celestia's goal as a protocol, is to generate meaningful fees, and the way that we do that is just like any other layer one, selling block space. Now, we are like a wholesaler of block space. So we sell it relatively cheap. Right now it's basically free. So I think a big change that we are going to be looking at is like, okay, what's actually a fairer way to price the block space that we're selling? Because selling it for free is not really fair to the Celestia protocol. But no one yet knows where the sort of price of block space will land up. At minimum, it should be sold at cost to the network of like how much it costs to produce. But there's going to be a big, I think that's going to be, I was also talking to some of the Ethereum folks about, even they think that they're also selling their blob space for too cheap. So there's going to be, I think, over the next year or so, more discussion and movement around like, how do we price block space in a more fair way? And then long term, if you're a wholesaler of block space, then you make money on volumes. So Celestia is kind of an index on broader crypto adoption and how many people are transacting on chain. And then hopefully, as crypto as an ecosystem scales, the overall volume of block space hits thresholds that are very compelling. So like if for example, if Celestia is doing 1 million transactions per second, then it can be making billions of dollars in revenue, even at today's prices, or close to today's prices, which are very cheap. So it just depends on how much broader adoption like the ecosystem will see in the near term. Long term, people also have this mistaken idea that block space is a commodity. It's not a commodity. It is a commodity now because there's not enough activity and there's not enough value on chain to really build up network effects. Ethereum may have a slight network effect around their block space, and that's why I think they have more pricing power for their blobs than let's say Celestia. But even that is still so early that it's not that strong. Like long term, I do think there's going to be maybe one or a handful of block space providers that end up kind of winning from a network effect perspective, and having the most pricing power and being able to charge the highest margins. And so that's what we're most focused on, is growth towards being a block space provider that has network effects. And those network effects come around from the same things that the Ethereum people and Solana people have been talking about forever: valuable state, and so like the GDP of this on-chain economy. Because as a builder, you're going to want to co-locate on that same data availability network, that same security network, so you can have privileged ability to interoperate and plug in and compose with the other assets and businesses in that ecosystem. It's just going to take a while, I think, before that fully manifests.
Yeah, last question also here before wrapping up, and I think this is exactly where we are getting into the core of that discussion, because I remember a tweet of yours like a couple of months ago, I believe it was, where you said that this revenue matter is also a little bit confusing because you can't price blockchains the same way you price an S&P 500 company with solidly revenue. We have seen it also in the startup world in the early days with Uber selling rides or way cheap. I remember times when they sold like rides in Berlin for €2 to drive from Mitte to Friedrichshain, which is like obviously not worth it, but they had like adoption. I think this is like exactly where we are now. However, there was like very strong like customer demand, and in blockchain generally right now, I think we are missing the customers right now. So how do we basically get around that? So how can we bring more activity on chain? What's the path forward? Is it like in regions like here, where like I had an interesting conversation before, where people are more or less forced to use on chain because banking doesn't work for them? Or is it we just get colonized by the banks in the US? So what is the game plan?
Yeah, well, I think I remember the tweet you're talking about, and I think that revenue is very much the North Star, and what like L1 protocols should strive for, unless they're trying to be a store of value. And the issue is that people are over-indexing on revenue in the present moment versus trying to project into the future of like what the revenue potential is. And I think it's more difficult also because the whole ecosystem is so early, and a lot of these protocols like Celestia are so young. They're kind of like startups, and it's like it's very difficult to project the future revenue of a startup. You kind of need to look at like the growth of like growth metrics, and like is the demand to use this platform growing? And I think in Celestia's case, at least on a quarterly basis, we've been sustaining through this year about 45% growth, the quarterly growth. And so like the growth is there. The revenue is not there because, like you said, with Uber, we're subsidizing it right now. We're not actually charging a fair price for the service we're giving. And so, Uber, a lot of it's a famous, kind of like startup playbook: grow, get big at all costs, and then once you're big enough, like try to actually turn on the revenue and the revenue. Like it's kind of like the fee switch essentially. And I do think Celestia is in a similar boat in the sense of like the fee switch is off right now. So you can't, like if you look at the Block Explorer, it'll say, oh, Celestia only makes $50 a day, which is a joke. And it is a joke because it's not actually a meaningful metric when the fee switch is off. I actually kind of wish in some ways we could just turn it to zero, because then it would be clear that it's not a reasonable, it's not like we're trying to make money right now. We have it as a spam prevention mechanism. You have to have a fee in your protocol. Otherwise, someone's going to just spam it and going to be really bad for your users. So, yeah, I think that's the way I think about it. Like, grow. Eventually, when you're big enough for it to be meaningful, shift the attention more towards the revenue aspect.
Yeah. Just like one question out of curiosity, like, is there like a metric that you could look at where you could say, okay, assuming that the fees which would have been turned on now, like what would be like the revenue of Celestia? Is there like a metric?
Good question. So without knowing what the fair price of block space is a little bit hard. Yeah. And now I have done some back of the napkin math on, like, let's say we were, the end user fees that we're targeting was sort of similar to Solana. And then Celestia as a block space provider takes on some take rate, maybe 30% of the end user fee or something. And I think with those numbers, I arrived at like maybe a few $1 million per year at the current levels of throughput, which is still not very compelling. But we're still only at like a 1% utilization of our total block space. And so I'm very hopeful that, for example, these cloud networks, if they go live and they consume as much block space as we think they will, in the order of like, it's very plausible that just even one of these clobs could consume roughly, 50x more than the current total consumption of our entire ecosystem right now. So 50x could easily get us into the like mid tens of millions in revenue per year, or even more. Let's see. Yeah, I think we're playing the long game. We're extremely well capitalized, so we're not necessarily, we don't have. It's a privilege to be able to think strategically and structurally about like how do we win long term, and not be forced by the market to prioritize things in the near term that actually won't serve us and lead to like the ultimate outcome that we want.
Amazing. I mean, last question. I think we just touched on it. Like, what's like Celestia's strategy in order to bring more rollups to the space, more applications, more users?
Good question. So I think early on, we had this idea that, okay, there's going to be thousands of rollups because everyone's going to want to build one, and rollups are the new smart contracts. And our vision was always and remains to make it as easy to deploy a blockchain as it is to deploy a smart contract or to deploy a website. The reality is that today, it's going to take us longer to get there than we expected, I think. Still pretty difficult and expensive to build your own chain, even if it's a rollup, even though you save all the costs of the validator set and issuing a token and having a security budget and whatnot, and all the operating costs of having all these validators, but you still have to host a lot of other infrastructure, whether those are oracles or RPCs or block explorers or indexers or all kinds of different integrations you need to do. And that like adds up essentially. So what that means is that rather than, whereas previously we were focusing more on the long tail or like the broad base of like, hey, come and build with these tools. The reality is that there's a much smaller set of users that are really high quality, for whom the Celestia product and stack makes a ton of sense. And those are very, very high value users who are, maybe enterprises with a large user base who need the scale and the customizability and the performance of what Celestia can provide. Or there are these clobs that already have pretty strong product market fit, are likely to generate meaningful revenue and fees and transactions to Celestia. So it's kind of like what I'm trying to say is we're shifting gears to focus more sort of I would say, like intentionally on the really, really high value users and make sure that they're successful, because we think, you know, there's always a power law of like the biggest apps versus like this long tail. And I think for now, app chains even roll-ups don't really serve the long tail that much. And anyway, the long tail of crypto is not that big or valuable, unfortunately. And so like focusing on the bigger targets, working with them closely is sort of where we see the most value for Celestia.
Sounds exciting. Then, with that being said, then excited to see what the world looks like in 2026. Celestia heading into this sphere. So, yeah, all the best, and thank you for coming on, and enjoy the rest of your time here in Buenos Aires.
Appreciate it. Thank you.